Welcome to another accounting lecture in which we're going to talk about the stockholders' equity section. In this video, we're going to talk about issuance of common stock. So let's take a look at an exercise, a rather simple exercise to get us started. In this exercise, we are told that in the first year of operations, Mona Corporation has these transactions pertaining to common stock. On Jan 10th, they issued 30,000 shares for cash at $5 per share. On July 1st, they issued 60,000 shares for cash at $7 per share. They've asked us two separate assumptions. First one, to journalize assuming that the common shares have a par value of $5. In part B, they're telling us assume that the common share has no par value, but a stated value of $1 per share. So let's start with part A, in which I'm going to write my date for the journal entry, which is January 10th, 2020. I issued shares. The word issue means I sold. I sold shares, I got cash, $5 per share. So 30,000 times 5, that's how much cash I got. So I'm going to debit cash and the amount's going to be $150,000. If you look at my formula bar over here on top, I have 30,000 times 5, 150,000. How much can I credit common stock? Only at $5 per share. Now in this case, $5 per share is a par value, and that's exactly what I sold it for. So the entire amount's going to get credited to common stock. Common stock, $5 par value, $150,000. Let's look at the July 1st transaction. On July 1st, again, I sold shares for cash, so cash is going to be debited. I sold at $7 a piece, 60,000 shares. So how much cash did I get? 7 times 60,000. I collected a total of $420,000. How much can I credit my common stock? Again, only at par value. The par value is 5. So 5 times 60,000 is how much I can credit my common stock. What happens to the difference, the $2 extra per share? That amount is an extra amount that the investors were willing to pay me to become owners in my company, buy my shares. So that is paid in capital in excess of par value. So over and above the par value, they gave me this extra money. So that's $120,000. All of this belongs to the stockholders. But when we look at the last exercise where we see the balance sheet presentation, you'll see how this becomes important, that we want these in separate accounts. Now, let's look at part B. We're changing the assumptions. We're saying that the stock has no par value. What it does have is a stated value of $1. So here we have, again, on the same date, we're doing the journal entry. So we're not doing part A. We're saying this is what our assumption is. How much cash did I receive? That stays the same. That's not going to change. $150,000. I received 30,000 times 5, 150,000. How much will I credit common stock? Now in part B, we are saying it's $1 per share is the stated value. So I will credit common stock $1 stated value. So that amount is going to be 30,000. So 30,000 shares times $1. Now, what happens to the remaining amount? That's going to be credited to paid in capital in excess of stated value, and that's $120,000. Let's do the same thing on July 1st. Again, cash is going to be debited. The amount is exactly the same as we had said before, $420,000. What's different is, again, common stock is going to be credited at stated value. That's going to be 60,000 times 1. And the remainder goes to paid in capital in excess of par. And that's going to be $360,000. So it's $7 was the selling price. If 1 is stated value, 6 is in excess of par. So 6 times 60,000, or you can simply take the difference of 420 and 60 and come up with the 60,000. So this is a relatively straightforward exercise in which we were either given the par value or the stated value. Remember, the common stock account can be credited only at par value or stated value. Anything in excess is going to be credited to a separate account called paid in capital in excess of par or paid in capital in excess of stated value. So with that, we finish this exercise and we'll move on to a different exercise in a few minutes.